Welcome back to Gold Rush Reporter, the place where we deal with precious metals honestly instead of repeating market fairy tales. Today's discussion hits a nerve because it exposes why so many people lose money in gold and silver, and how quickly things can fall apart when emotions replace strategy. If you think your portfolio will magically recover just because you want it to, then you're already setting yourself up for disaster. Before we go deeper, tell me in the comments if you've ever held a losing position simply because you believed it had to bounce. Don't pretend. Everyone has done it at least once. The truth is brutal but simple. Inexperienced investors get crushed during downturns, and silver holders take the hardest hit every single time. When the price starts slipping, the weak players panic and dump their positions, hoping to save themselves from a deeper loss. They don't realize that by the time they panic sell, most of the damage has already happened. They're always late because their decisions are driven by fear, not logic. They talk about waiting for a breakout, or selling when they break even, or holding just a little longer for a miracle recovery. None of that is analysis. It's emotional bargaining with the market, and the market doesn't care. Most of the damage investors experience isn't caused by gold or silver themselves. It's caused by their own impulsive behavior. They buy hype instead of studying fundamentals. They follow influencers instead of learning how cycles actually work. They treat precious metals like lottery tickets instead of long-term strategic assets. Then they act surprised when the market punishes them. The sad part is that the pattern repeats in every single cycle, and nobody seems to learn from the previous one. During bull runs, you'll see people bragging about their big gains, acting like they predicted everything. What they don't mention is that months earlier, when the market dipped, they were panicking like everyone else. Most of them sold too early, bought back too late, and ended up chasing the price the entire time. The market rewards discipline, not noise. The people who actually survive and grow their holdings are the ones who respect trends, manage risk, and stay calm when everyone else is losing their minds. Silver is an even harsher teacher than gold. People think silver is just a cheaper version of gold with more upside. They forget it also comes with violent downside. A small correction in gold can become a brutal crash in silver, and beginners never see it coming. They jump in for the upside and get blindsided by volatility they were never prepared for. When their positions collapse, they point fingers everywhere except the mirror. They blame manipulation, central banks, whales, the Fed, anything that lets them avoid admitting that they entered the market without a plan. So here's the question you need to answer honestly. What's the biggest mistake you've made in gold or silver? Buying at the top? Selling in fear? Trading without a strategy? Drop it in the comments and own it. That's how you stop repeating it. The cycle of emotional trading doesn't end with panic selling. It gets worse when investors convince themselves that they're being patient. They sit on losing positions, telling themselves the market must eventually reward them simply because they waited long enough. That's not patience, that's paralysis disguised as strategy. Real patience is backed by research, risk control, and a clear reason for holding. What most people do is completely different. They cling to bad entries and pray for a recovery, turning their portfolios into hostages of their own wishful thinking. And the longer they hold without understanding the trend, the deeper they sink. No one likes hearing that their losses are self-inflicted, but avoiding that truth guarantees they'll never improve. One of the biggest traps people fall into is averaging down blindly, thinking they're being smart. They buy more of a falling asset without asking why it's falling in the first place. They treat every dip like a discount, even when the fundamentals clearly don't support a bounce. This mindset destroys accounts because it multiplies exposure to weakness. If you average down without confirming strength or without a rule-based plan, you're not being strategic. You're doubling your gamble. The market isn't obligated to reward stubbornness. Sometimes the trend keeps moving against you for months, even years, and you're left holding a bigger bag than you ever intended. Then there's the fantasy that gold can't go down too much, or silver always comes back. That kind of thinking is exactly why people get blindsided. Yes, gold is historically strong. Yes, silver has long-term potential. But neither asset exists to protect you from your own bad decisions. Both metals experience deep corrections and long sideways phases. If you enter at the wrong time without understanding macro conditions, you're setting yourself up for a long wait filled with frustration and doubt. Most beginners don't survive those phases. They break emotionally, sell at the bottom, and swear off metals forever, right before the market reverses. Another problem is overconfidence during short-term rallies. Investors see a few green candles and suddenly imagine they've mastered the market. They start making bigger trades, taking on more risk, and talking like experts. Then one sharp correction wipes out everything they gained. Precious metals reward discipline, not ego. An uptrend doesn't mean you're a genius. It means you're temporarily on the right side of the market. If you stop respecting risk, you'll get punished fast. And silver's volatility can erase weeks of gains in a single bad day. What makes all of this worse is that most people never track their mistakes. They don't write down why they entered a trade, what their exit plan was, or what information they ignored. Without that record, they repeat the same emotional reactions over and over. They blame manipulation instead of acknowledging that they're trading blind. The truth is simple. You can't fix what you refuse to diagnose. If you're serious about surviving in gold and silver, you need to analyze your behavior as brutally as you analyze the charts. Before we go deeper, answer this honestly. Do you actually have a written strategy for your gold and silver positions, or are you improvising every single trade? Put it in the comments. Another major weakness most investors refuse to confront is their complete dependence on feelings instead of data. They buy when they feel excited, sell when they feel scared, and call it strategy. That mindset guarantees failure because markets don't move according to your emotions. Gold reacts to macro trends, liquidity flows, currency pressure, and institutional demand. Silver reacts even more violently because its market is tiny and heavily influenced by industrial cycles. But instead of tracking these real drivers, beginners focus on rumors, thumbnails, and hype channels screaming about the next moonshot. They think watching 5 bullish videos means they did research. It's no surprise they walk straight into traps that experienced traders saw coming months earlier. The next painful reality is that most people don't know the difference between long-term accumulation and short-term speculation. They mix both without understanding either. They say they're long-term, but panic the moment the price dips 3%. They claim they're trading trends, but they don't have entry rules, exit rules, or stop-loss discipline. They try to act like investors and traders at the same time, which means they fail at both. Gold and silver punish confusion. If you don't know why you're holding something, you'll always react emotionally when the market pressures you. And the market will pressure you, guaranteed. People also underestimate how brutally the metals market exposes ignorance. For example, when inflation cools, beginner investors still expect gold to pump because they heard gold loves inflation. They ignore the fact that real yields, interest rates, and bond markets matter more than CPI headlines. Or when the dollar gets stronger, they convince themselves it won't affect gold this time, and then act shocked when prices fall. The same happens with silver. People assume industrial demand will magically overpower monetary headwinds. It doesn't. If manufacturing slows, silver gets crushed. It's not emotional, it's mechanical. But beginners keep pretending those correlations don't exist because they want a simpler story. Another common flaw is blind trust in influencers or analysts who never show their own positions. People follow anyone who sounds confident, not realizing confidence means nothing without accuracy and accountability. They chase predictions instead of probabilities. They want someone to tell them where gold is going next, as if that certainty even exists. The truth is that good analysts don't predict. They prepare. They map multiple scenarios and position themselves for whichever one plays out. Beginners do the opposite. They marry a single narrative and ignore any evidence against it. When the market proves them wrong, they scramble, panic, and make even worse decisions trying to recover. Most investors also underestimate time decay. Mentally, not just financially. When you hold a bad position for months, hoping it will recover, the emotional exhaustion drains your discipline. You stop thinking clearly, stop planning, and eventually accept whatever loss feels tolerable. That's how people sell at the bottom every cycle. They're not defeated by the market. They're defeated by their own lack of strategy and emotional stamina. Precious metals require resilience. If you don't have it, the market will expose you faster than you think. So now answer this honestly. When you buy gold or silver, do you actually understand the macro conditions behind your move? Or do you just hope you're early? Drop the truth in the comments. Another brutal truth most investors never acknowledge is how easily they get manipulated by short-term noise. A single red candle makes them question every decision, while a green candle suddenly convinces them they're geniuses. This emotional volatility is worse than price volatility. When you can't control your reactions, the market controls you. Gold and silver don't punish people because they're bad assets. They punish people who treat them like casino chips. If you panic every time the market moves against you, you were never invested. You were just gambling with extra steps. And if you celebrate too early after a few good days, you're setting yourself up for another blindside. People especially struggle with sideways markets. They think consolidation means nothing is happening, when in reality, it's one of the most important phases in any trend. Sideways action is where strong hands accumulate and weak hands lose patience. But beginners can't stand the boredom. They want action, excitement, drama, so they trade every small move, thinking they're being active when all they're doing is bleeding capital through impatience. The metals market rewards people who understand that not every week needs a trade. Sometimes the smartest decision is to sit still, watch the macro signals, and let the market reveal its direction. Another big issue is false confidence built on 1 or 2 lucky wins. Many beginners catch a good move by accident and suddenly assume they've mastered the market. They increase their position sizes, ignore risk, and start acting like professionals after barely understanding the basics. Then, one sharp correction wipes out months of gains in hours. They call it bad luck, but it wasn't luck. It was their own arrogance. Luck may give you a win, but discipline keeps you in the game. Without risk management, the market only needs to be right once to wipe you out completely. A lot of investors also get trapped by narratives that are only half true. For example, they hear that central bank buying supports gold, which is correct, but they never consider timing, liquidity cycles, currency pressure, or real yields. They hear that silver is undervalued relative to gold, which is often true, but that doesn't mean silver will move when they want it to. They hear that miners outperform in bull markets, but they ignore the fact that miners collapse twice as hard in downturns. They take small pieces of truth and build entire strategies around them, which is why they end up shocked when reality doesn't match their expectations. The most dangerous habit, however, is chasing losses. When people lose money, they start taking bigger risks to get it back, as if the market owes them a refund. That mindset destroys portfolios faster than any price tip ever could. Once your decisions are driven by revenge instead of logic, you're finished. You start buying impulsively, holding too long, selling too late, and digging the hole deeper. The market isn't your enemy, but when you trade emotionally, you become your own worst enemy. At some point, every investor hits a crossroads where they either evolve or get wiped out. Precious metals don't give endless chances. Gold and silver expose your weaknesses faster than stocks ever will. If you don't understand macro trends, they punish you. If you ignore risk, they punish you. If you invest emotionally, they punish you. And if you keep repeating the same mistakes, they eventually force you out of the market altogether. The smartest investors aren't the ones who never lose. They're the ones who learn quickly, adapt, and remove ego from the process. Ego is the single biggest enemy in this space. It tells you that you're right even when the charts prove otherwise. It convinces you to hold garbage positions just because you don't want to admit you bought at the wrong time. It pushes you to ignore signs that a trend has reversed. If you don't kill your ego, it will quietly kill your portfolio. A lot of people enter gold and silver because they want security, but they treat the market with the same recklessness they use in speculative assets. That contradiction guarantees destruction. If you're using precious metals for stability, then stop trading them like a roller coaster. If you're using them for long-term preservation, stop expecting immediate gratification. And if you're using them for short-term profits, then take responsibility for studying the cycles, the macro drivers, and the technical signals. You can't switch strategies every week and expect consistent results. This market rewards clarity, not confusion. The hardest lesson investors learn is that discipline is more valuable than predictions. Nobody knows exactly where gold will be next week or how violent silver's next move will be. What matters is how prepared you are for both outcomes. Most people think preparation means watching price levels. It doesn't. Preparation means having rules. It means knowing your exit before you enter. It means accepting the possibility of being wrong and protecting your capital when the market proves it. If you don't have rules, the market will impose its own rules on you, and those rules are always painful. In the end, success in precious metals isn't about luck, timing, or finding the perfect guru. It's about having the patience to survive the boring phases, the discipline to survive the violent phases, and the intelligence to avoid the stupid phases. If you can master those three things, the market will reward you. If you can't, the market will chew you up and make room for someone who can. And that's the honest truth most investors avoid because it forces them to look at themselves instead of blaming everything else. If you actually want to thrive in gold and silver, stop waiting for miracles and start building a strategy. Stop chasing hype and start tracking fundamentals. Stop reacting emotionally and start thinking like someone who wants to stay in this market for years, not weeks. Thanks for watching Gold Rush Reporter. If you learned something today, make sure to like the video, drop a comment with your biggest lesson, and subscribe for more hard-hitting analysis without the sugarcoating. I'll see you in the next one.